The day the market crashed in minutes, the 2010 flash crash. But before we get started, make sure to like this video and subscribe to the channel so you don't miss any new contents. On the afternoon of May 6, 2010, the U.S. stock market was already under pressure. Fears surrounding the European debt crisis had investors on edge, and volatility was building throughout the day. Then, in a matter of minutes, the system cracked. What followed became known as the 2010 flash crash, one of the most dramatic and unsettling moments in modern financial history. At around 2:32 p.m. New York time, a massive automated sell order hit the market. It wasn't placed by a panicked human trader, but by an algorithm designed to execute trades efficiently without regard to market conditions. The program began unloading billions of dollars worth of futures contracts tied to the Dow Jones Industrial Average. Under normal circumstances, buyers would step in to absorb the selling, but this time was different. High-frequency trading algorithms, built to react in microseconds, detected the sudden surge in selling pressure. Instead of stabilizing the market, many of them did the opposite. They pulled back liquidity or began selling as well, amplifying the downward spiral. In seconds, human decision-making was no longer in control. Machines were trading with machines. Liquidity vanished. Prices began to collapse across the market. Blue-chip companies briefly traded at absurd levels. Shares of established firms plunged from tens of dollars to mere cents before rebounding. The Dow Jones plunged nearly 1,000 points, about 9% in less than 10 minutes, marking one of the fastest drops in history. Then, almost as quickly as it started, the market snapped back. By 3 p.m., much of the loss had been recovered, but the damage was done, not just financially, but psychologically. The event exposed a dangerous reality. Modern markets were no longer purely driven by human judgment, but by complex, interconnected algorithms capable of triggering chaos at incredible speed. In the aftermath, regulators investigated the event extensively. They concluded that no single factor caused the crash, but rather a chain reaction, an unstable feedback loop between automated systems operating without coordination. New safeguards were introduced, including circuit breakers designed to pause trading during extreme volatility. Yet the core lesson remained clear. The 2010 flash crash was not just a glitch, it was a warning. In a world where speed dominates and algorithms compete in microseconds, markets can move faster than humans can comprehend. And sometimes, in that race for efficiency, stability is the first thing sacrificed.